humorous. My very first day, my very first 15 minutes on the job, we were actually robbed at the bank. I was standing behind the teller as I was being introduced to the teller. There was a man robbing us and took about three to $5,000 out of the pocket of the teller I was talking to.
Hello, everybody. Welcome back again. My name is Oliver Perry, and I am here today with Mr. Clay Allen, a CCIM and a senior director over at Old Capital. He's been playing the financial game for quite a while. He knows quite a bit in regards to multifamily, and he and I are going to have some conversations. But to start, Clay, if you don't mind, could you break down who you are, what you do, and how you play the game in the multifamily realm?
Sure. Yeah. Thanks, Ollie. This is a pleasure. And long story short, I'm living in Atlanta. I'm born and raised in Georgia. I have spent 9 years in the banking field, 9 years at GE Capital, and another 5 years as an asset manager for two large multifamily groups, covering primarily the Southeast, but some markets northward, say Boston, for a brief period of time, Chicago and Columbus, Ohio. But other than that, mainly focused here in the Southeast on lending to clients like yourself and to other GPs. A lot of them early stage multifamily owners or aspiring owners. And so I really enjoy the education piece, really enjoy just talking multifamily shop.
Nice. Nice. So, Clay, with what you do because now you're senior director, but you, like you said, you were working in GE, you were doing a whole bunch of stuff before becoming senior director. What was that path like? What were the kind of things that you had to kind of learn and figure out and develop in self when it came to, understanding the numbers of the game? Because I know a lot of people who are listening may be newer to the multifamily realm, and they look at that that analysis sheet for multifamily, and like me, say no, I'm gonna leave this alone. Like, how did you go about building that skill?
Well, anyone doing the math when I told you how many years I was in a bank and all that, it totals up to about 23 years. So I started out in the banking field back in 1997 as an intern while I was in college. I was a junior in college, and so started really at the bank branch level. And I tell some people it's kind of humorous. My very first day, my very first 15 minutes on the job, we were actually robbed at the bank. I was standing behind the teller as I was being introduced to the teller. There was a man robbing us and took about three to $5,000 out of the pocket of the teller I was talking to at the time. And
wow.
So that's where I started. And it took a long time. I went up the portfolio management route, credit training, just a number of things that most people coming into the industry would go through.
Right.
And over time, it just kind of progressed, I guess you could say. I went back, got my master's of science in real estate. I started back in '01 when I moved back to Atlanta from Birmingham. And from there, I took that master's for a spin after getting that completed and went to GE Capital. And that's where I joined on the originations team. I was skinning a lot of deals, underwriting a lot of deals for the joint venture equity platform. So I went from the lending environment to the joint venture equity environment, which, by the way, it all comes down to cash flows. It doesn't really matter. It's just structurally it's different. It's real estate finance at the end of the day, whether it's debt or equity. And then after '08 happened, I found myself as an asset manager. It wasn't that I wanted my career necessarily to go that route. I was so blessed to have a job after '08. I got a nice letter in the mail saying, "Congratulations, you're now an asset manager for GE." And I was like, "I'll take it. That sounds great."
Absolutely.
So did that, and made my way over to the debt side, where I was an underwriter for the GE portfolio debt and CMBS platform, so permanent financing in the capital markets. And finally, GE sold off everything. And at that point, I was at a kind of a juxtaposition. I decided I'm just going to go to the ownership side. From the finance side, I'm going to go to see what it's like to be an owner. So that's when I became an asset manager for what would become two large multifamily groups. And so from that experience, I was able to operate as a GP would, right? I'm communicating with investors. I'm preparing the budget. So I'm writing the business plans, managing the manager, if you will. So that was a really a fantastic 5 years that I did that, but kind of missed the transaction side. So that's where I came back to Old Capital. I had 20 plus years when I came to Old Capital, so that's what got the senior in front of director. So now I'm senior director. So just been around a while, and finally, just kind of gradually working my way up.
Wow. So that's a lot. That's a lot. And first of all, that is a hell of a way to start off a career with a bank robbery. That's one for the record books there.
It is. It is. It is. I'd love to say that I was really brave and I came across the desk and tackled the guy, but the reality is my legs were weak. I had no clue. I didn't know what to do. I followed the guy out and got a description of the car, but that's about it.
I tell you what, Clay, if you had said, I jumped over the counter, I grabbed the guy and slammed his head into the window, I would have backed you up 120%.
I wouldn't be in finance if that were the case. I would probably be a
right. Right. So you did say something that I think I don't know if anybody else picked up on, but I picked up on, and I know that in each branch of multifamily, I'm starting to find that everybody has a different language, and you said skinning the deal is what you said. I think you said, yeah. So that's a term meaning you're just going through and going through deal after deal after deal, correct?
That's right. You're underwriting every deal, and I guess the root of that terminology would be for a hunter. You bag some game and you got to skin it and process it. And I'm guessing that's where that came from. But yeah, it's just simply, in the case of the JV equity, I was there for a couple of years, and I think I underwrote probably $2 billion of market cap deals.
Wow.
That doesn't mean like a full underwriting. When I say skinning it, it would be taking a very quick look at it, running the numbers, seeing if it really met our return thresholds, moving on.
Okay. So that's what I've heard some also say, like the back of the napkin look.
Yep.
It's that quick vision on it.
Pretty quick. I mean, back of the napkin would probably be a very quick view. This would be solving for some cash flows for some returns to see if it met our return hurdles at a high level. A lot of cases that would be just looking at it from the broker's cash flows.
Right.
In an offering memorandum, they're going to show you a 5 to 7 year pro forma that the broker comes up with. And to be fair, most cases the broker numbers are going to be a little bit ambitious. And so with that, if the numbers aren't really lining up at the underwriters or the brokers' numbers, likelihood is you're not going to be able to get there from a purchase price standpoint for your return hurdle. Right. So it's a quick pass. Usually takes a couple hours, to do it. But
so let's dig into that a little bit. So you've underwritten a lot of deals in your career at this point. When you go through those deals, I imagine at some point you get to the proficiency level where all you have to do is look and okay, this is going to work out, this is not, or this deserves me to dig in, this doesn't. When you first started, what were the numbers that you're looking at saying, okay, I need to look a little bit deeper? Because I think that's something that I find myself that's to be difficult, particularly when looking at, like I said, the analysis sheet is huge. But there's always a key to everything. On the single family, I could see, okay, if this number is this, then I know I need to look deeper. What's for you that sign that tells you, okay, I need to look a little bit deeper into this deal when skinning the deal?
Yeah, so, boy, I'd have to go back and really think hard on that from the JV equity days at least. But from a lending standpoint, in most cases, and most acquisition guys would probably look at the expenses to see if they're in line.
Right.
And then, I think we really look at the major categories first.
Okay.
Major categories being total income, total expenses.
Right.
You kind of line up, rent growth numbers that are being used. Are they a little bit too ambitious? And I'm thinking about, let's say, the broker numbers right now for the sake of argument.
Right.
If they're saying, yeah, we think you're going to get $200 rent bumps and market rent growth is going to give you 3 to 4% for the next 5 years, yeah, those are the type of numbers where you kind of have to do a gut check, and you kind of know that I'm going to have to go back to CoStar data, Axio data, or just use my own data to find out rent growth, what appropriate rent growth should be over the next 2 to 3 years.
Hmm.
From an expense standpoint, you're kind of looking at the operating expense ratio, or how does it compare to the total EGI?
Right.
Generally looking for about no more than 50%, about 40 to 50% expense to income ratio. If it's a lot higher than that, then the current owner probably has been operating it way too fat, and there might be
Hmm.
opportunity to cut back expenses. If it's way less than that, they're operating it way too thin, and you're going to have to come in and put in some realistic expenses. So again, just kind of looking at it from a major category standpoint and then digging in from there.
Okay, awesome. So that's from analysis standpoint. Now, where you're at now is the lender view. When you're looking at deals, and let's say somebody comes to you and says, "Hey, Clay, I got this great deal. I got this great deal." What makes you, as basically the lender, comfortable with giving someone that funding, and what doesn't, and how do they kind of fix? Is there a way to fix that along that path?
Well, we generally look at when we're talking like a back of the napkin, or I call it kind of a
Hmm.
quick look at it before I start shopping it out to a bunch of different lenders.
Right.
I'm looking for, especially in today's times, I'm looking at the occupancy and the economic occupancy, so
Okay.
physical and economic. So the physical, if you're looking for agency financing, you're going to want to be at 90% or greater for the trailing 3 months. They call it 90 for 90. So 90% occupancy physical for a 90-day period, at least 90 days. So that's one measure we kind of immediately look at to see if it would qualify from that standpoint. From an economic standpoint, the lenders, whether it be bridge, bank, or agency, they're all very sensitive as to who's paying rent. Is
Mm,
are the It's great if you have 95% occupancy, but if
right.
you only have like 80% of your residents paying the rent, then
Right.
it doesn't do you any good.
Right.
So,
That's no point. That's pointless.
so that's definitely a measure we're paying attention to, and that's something that
Right.
I look at immediately. Aside from that, we will generally look at uh, cap rate just to see how it sizes from a value standpoint. Is the borrower really overpaying for a deal for the market that they're in, or is it kind of lining up with what we're seeing?
Right.
So pretty high level, and then we'll shoot it off. And what I generally do, um, depending on the lender, I will put together a quick um, bullet pointed summary of the deal, of the
Hmm.
sponsor, of the opportunity for the lender, so that they can kind of quickly size it themselves and tell me if they're interested or not, and under what terms they might be interested.
Wow. Okay. Wow. Yeah. That's. I mean, that makes sense. Now that I'm thinking about it, a lot of that we've done, at least for our and Forerunner Investing Group, we've seen our underwriter Hema is very skilled in that manner. So
She is.
she
She
gets
really is.
after it. Absolutely.
Hmm.
Absolutely. So you're in Atlanta now.
Hmm.
What's your thoughts on how the money has changed from as far as lending and as far as borrowing, whichever you choose, from the time where the market crashed, like the market really had that reset in '08 to now? Because we all talk about the market itself, but we don't always talk about that secondary part of it, which is where the money comes from, how it moves, what's the prominence and things of that nature.
Yeah. And I'm sorry, you're asking though, how's it changed from '08 to today?
Correct.
I guess.
Right. So how's the
Okay.
kind of lending process changed? How is it, versus somebody going to private? They used to go to private. They used to go to hard money. Now it's
Yeah.
a lot of banks and things of that nature.
Sure. So I spent many of my years as an asset manager in between that time. So I
Okay.
wasn't directly involved, but I can tell you, and as you imagine, things tightened up after '08. Before that, it was very liberal in how you could get loans funded.
Right.
You had a lot of bridge lenders in the space. Well, shoot, even banks. Agencies were very aggressive. A lot of money chasing deals,
Hmm.
and so you kind of know the rest of the story there. We ended up with a lot of debt securitized that didn't belong there, and investors weren't getting paid on what they bought the securitized debt. So it was a bit of a mess. And so after '08, lenders really tightened up. Now, as fundamentals really improved coming out of 2010, and frankly up until now. we've seen really good fundamentals in the market. You've seen rent growth really outpacing income.
Wow.
So it's become, as you can imagine, not as many people could go out and buy a home post '08, so
Right.
people kind of started shifting their focus to multifamily or to rentals, and so that showed up in the rent growth. The
Hmm.
demand was outpacing the supply, and on top of that, you also had interest rates that were already low and historic lows. I remember back in, I think it was 16, I was working as an asset manager, and I was wondering why we were floating our debt versus getting, locking in some of this fixed rate, really low
Right.
debt.
Right.
That, I proved to be wrong because the rates continue to fall, and you know where they are
Right.
today, post pandemic, very low. And so, yeah, the whole environment, frankly, has been very favorable for owners
Hmm.
um, up until today, still. And so it's been a very, very favorable market. Now, what I'd tell you is I kind of feel like we've reached this point where rates are where they are. I
Hmm.
don't know that they're going to be a lot of give. There's some debate about that, but I've got to think that rates are going to kind of bottom out here. It's only up from here, is my guess.
Right.
And on top of that, because of that, I don't know that you're going to see a whole lot of cap rate compression at this point. We've seen tightening even post COVID, where you see this 4 to 5% spread between A and C class properties.
Right.
Um, I'm not sure that you're going to see much better than that. So what I tell people, especially if you're a value add player, it is really incumbent on you that you deliver on what you promise. And what I mean by that is back in my asset management days,
Hmm.
we could buy a property. Let's say 2017, we could buy a property and say we're going to add value to it. We're going to put in $6,000 per unit. We're going to get $100 premium. In most cases, we really weren't getting that premium. We were getting some good market rent growth,
Hmm.
but we weren't seeing the full $100 premium or $150 premium that we thought. But we were making really good returns for our investors because we still saw some rent growth and cap rates were compressing. So values were increasing during that time. So we were kind of being bailed out a little bit as an operator. We were delivering great returns to our investors, but it was probably more attributed to the market, or evenly so attributed to the market as it was operating the property efficiently. So nowadays, because I'm not sure that we're going to continue to see that, if you say you're going to deliver $100 premium, make sure you prove that out before you buy the property.
Right. Right. It's that's interesting that you say that. I actually had the conversation with someone today in regards to just multifamily and how multifamily, and I'm sure you could attest to this, is it's literally a team game. And the wildest part is that once you get that first deal done, the rest start rolling in because people feel comfortable. They understand that you're going to execute and things of that nature. So I think, as you said, being a person of your word, man or woman of your word, is probably paramount in this particular time frame now more than probably ever. Um,
Mm-hmm.
and with that in mind, I wanted to ask you as well, for you in working now in Old Capital, what's your position as senior director? What do you kind of do now that you're in that position? Because it's asset management. You've done all the asset management stuff. You've done all the right underwriting stuff. I imagine that being the senior director is a different mindset and thought process now for you.
Well, it is, but frankly, I love it. It's right down the fairway for what I enjoy, what I like to do, and
Nice.
what that is, and what we kind of like to say. It's not like a slogan or anything like that, but we like to think of ourselves as an education company or marketing company that happens to do
Okay.
mortgages. Reality is that the way we make money is to put you guys in the right debt, to find the best
Right.
deals for you, and structure it correctly, and then do another deal with you, hopefully. But leading up to that, we do things like this. We put on an annual conference with a great headline speaker and great panelists. We put together a monthly speaker series with fantastic networking, which I'd encourage anybody to join. Just if you want to expand your network of general partners and limited partners, people looking to do deals, come join us on the monthly speaker series at Old Capital. Great venue.
Yeah, it is.
A lot of YouTube content, podcasts gets about 60 to 70,000 downloads or so per month. Really good content there. So it's all education. And I said it before. I just love to talk multifamily. So
Right.
if anyone ever wants to just say, hey, Clay, what's your thoughts on this market? What's your thoughts on this deal? Love it. I'll do that all day long.
So fantastic. So let's dive into that. This way we can give some beginners some thought processes and maybe things they need to look out for in their own area. So we'll talk specifically into Atlanta and the Georgia area just in general. What are your thoughts on the market status as it stands right now in Atlanta, and where do you see it going?
A lot of activity. If we're talking about Metro Atlanta, a lot of activity, and you hear this like say Dallas and other some of the other larger markets. We have a good amount of capital, international capital, but also the typical capital coming from New York and New Jersey. Um, that's not to even mention the local guys that here that know and operate in the market. It's
Right.
pretty competitive for that. So if you're a newer investor, let's say you've taken down one deal and you're trying to take down a 300 unit property, it's going to be tough.
Absolutely.
What I would say for a newer investor, uh, you know, try to aim for those properties that the institutions might shy away from. 100 units or less, probably at this stage. It might be a little bit more hair on the deal that it's not going to scare you away. Maybe it's not going to be a Buckhead type of market necessarily. It could be outside the city in a little bit more challenging market, maybe, or just even a secondary market. I was mentioning Atlanta, but
Mm-hmm.
Augusta has been really a hotbed of activity since really the past year. We've seen a number of deals trade there
Yes, I have.
recently.
Absolutely.
Looking at one today, actually, before this call. Um, so a lot going on there. I was actually on the phone with an owner out of California about an hour ago for a deal that they already own in downtown Macon,
Mm-hmm.
kind of a high-rise deal there, and that's a good market if you're looking to stay out of the fray of the institutions,
Mm-hmm.
But I'm partial to Athens, Georgia, because I'm from there. But that's a big student population, so be wary of that. But
Right.
Savannah's popular, Rome's popular. I'm trying to point people to like newer investors to some of those secondary markets because it'd be a lot
Right.
easier to gain traction.
Yeah, it's absolutely it's less challenging. I know Augusta for myself. I've actually military, so I've been to
Mm-hmm.
Augusta, and Augusta, I want to say in 2005 was a lot quieter. Now
Mm-hmm.
it's gotten even busier. People are paying more attention to sports like golf, and really picking up on the Masters, and they're realizing that the Cyber Command is out there in Georgia and Augusta as well. So that's picked up.
Mm-hmm.
So yeah,
Yeah.
I would totally agree with you. Augusta is on the rise, if you will.
Mm-hmm.
So, with that said, with your thought process, when you look at some of these places, and you said Augusta, you said Savannah, you said Athens. What
Mm-hmm.
are you when people are looking, and even outside of the state of Georgia, when they're looking at locations, what should they be looking for when they're looking at these locations?
Yeah, at a very high level approach, and some I might get my hand slapped for saying this, but at the end of the day, you're looking for population growth and income growth or job growth,
Mm-hmm.
or all three. If you
Right.
have population growth and job growth, you're gonna probably see some income growth. And then what we generally did as I was flipping through an old, I actually have it right here, an old credit request from my old days at GE. It was a loan request, and a
Nice.
package about this thick. I don't want to put it on there and give away any kind of details, but
Fair enough.
but it's a
Fair enough.
packet about this thick, right? And it's
Right.
going to cover all the major points: the market, the borrower, the collateral itself, the execution strategy, all that stuff. They generally look for those high level attributes. What's the population growth? How does it compare to the U.S. average? That's a good benchmark.
Right.
In most cases here in the South, you see markets, especially the larger markets, they're generally outpacing the U.S. average by say 1.5 to 2 times the
Okay.
population growth.
Right.
Of course, depending on the market. Similar with job growth. Um, I like to when I sell Atlanta. I've been in Atlanta. I've been a Georgia resident my whole life, but when I sell Atlanta to people outside the state, I make sure that they know that the airport, right? It can get you anywhere in the world, almost
Mm-hmm.
anywhere in the world nonstop.
Right.
It can reach 80% of the U.S. population within a 2-hour flight, and because of that, you have a very diverse economic base where it's airlines, UPS, and logistics, uh, hospitality. Hotels are based here. Restaurants are based here. Coca-Cola, of course. A number of large multinational corporations have their corporate and regional headquarters based here, and that it seems to be create a very healthy environment for. I don't want to say recession-proof because it certainly isn't, but it certainly helps it make it a recession-resistant market. Another one would be a large university presence or a state capital. Atlanta has both of those. You can go to most mid-sized large cities and you'll see some type of college there or whatever. Those jobs tend to stick around in a recession, right? Mm-hmm. So that's helpful. The government jobs tend to stick around in a recession. The private sector might suffer a little bit, but if you have a financial crisis, you still might have Amazon selling stuff,
right?
Or the banks might be suffering, but Coca-Cola is still selling Coke, right? So it's that diverse economy kind of keeps things a little bit in balance. So yeah, I would point to that when you're sizing up a market.
That's interesting. I sometimes it's interesting because sometimes we kind of forget that just like sports, there's a balance. The best teams are always balanced. So it makes sense, like you said, that there's a diversification with the different jobs. You've got Coke stops working. Amazon's still working. Amazon stops working. The city government's still working. City government's not working. Georgia State is still working. That kind of thing. So I think,
right.
Yeah, that's absolutely dead on, which is interesting. It's not something I thought about, but it's definitely interesting. Now, with what that said, and I'm sure you've been asked this a million times, but I'm going to ask you one more time, so it's going to be 1,000,001. With COVID-19, as we come to, God willing, we come to the end of COVID-19, what do you think is going to be the differences and the changes with us in multifamily as opposed to, of course, single family? They've got the forbearance thing, but with multifamily side of the house, I imagine things will be slightly different, just how we approach it and how things kind of pan out. What are your thoughts on that?
Yeah, as compared to other product types, other real estate product types, or
yeah, I'd say really the real estate product types as well as just how the multifamily world changes already. Because right now, it's a panic for some owners who are like mom and pop shops, the smaller owners, and they haven't been, they don't know what to do as opposed to 200, 300 unit. That's not, unless the entire 200, 300 people are not paying, it's not as big a deal.
Sure. So I think, all things being equal, let's say the vaccine does swimmingly well, the rollout continues and gets better. The vaccine rollout gets better. More people are getting the shot, and things start to improve by the third quarter. Hopefully we would see some lessening of the restrictions or maybe the reserves from the agencies, the COVID reserves, that is. So, and I'm kind of jumping into the debt side of the field, right? So like the agencies being Fannie Mae and Freddie Mac, they currently require a COVID reserve. I would guess that because those two entities compete with each other for business, I would think that would be the first thing to start to whittle away, is those reserves.
Right.
That's the hope. Yeah. Now, what they tell you too, I mean, Freddie's pretty clear about it, that they want to see, I think it's 3 months, of a post emergency declaration lift, and that's when they will do away with the reserves. So in other words, the emergency declarations at a national level and a state level need to be lifted, need to go away. Right. And they want to wait for another 3 months to make sure there's no resurgence. And at that point, they're kind of gone. That's the common thought right now. But it doesn't mean that they can't start to whittle those reserves down in between time. Yeah. So if things start to look better, I think we might see that. I also think that you might see the investor bases, realize that yields are so low now because cap rates are so low in multifamily. There's a lot of competition for it. That maybe office is starting to look a little bit more attractive if people are not having to stay at home as much. Maybe the retail apocalypse didn't really happen like we thought it would. Businesses are still in business, right? So you might see more appetite for those. Hotels, people are traveling again. I think there will be deals to be had in special servicing, from all this mess, and so there'll be great opportunity in those sectors. So you might find a little bit less investor interest, not because multifamily is not a great place to be, but because the risk-adjusted return might, um, it might shift a little bit towards
Right.
those other property types.
Interesting. Interesting. Yeah, I didn't know that was a legit question for myself. I was being selfish there, but
Yeah.
nonetheless, I appreciate it, Clay. That's fantastic. Okay, so now I know we're running low on time, so I wanted to make sure that we close out with two of my favorite topics and my favorite segments, if you will. And we're going to start
Okay.
with one called "Troop to Task," and what that is, Clay, is you give the listener one thing that they can do to take the next step forward in their multifamily adventure.
Okay. Yeah. So most people I talk to want to grow faster than someone who just wants to do it on their own.
Mm-hmm.
Someone who wants to do it on their own, they're going to take a very pragmatic approach. They're going to, their first deal is going to be that duplex. They're going to work it up to a quad. They're going to work it up to a 10 unit, 16 unit,
Right.
and work their way up. As you can imagine, that takes time and it takes your own resources.
Absolutely.
So the best thing I could do, I could recommend is network within people. Like I just mentioned, the Old Capital monthly speaker series. I'm promising I'm not trying to do a shameless plug here.
No,
All
no,
I'm
I'm
saying
okay
is
with the
that,
plug. I've enjoyed the speaker series, to be honest with you. So please
oh,
plug
good,
that.
good, yeah. Well, I've found immense value, even as a lender, immense value just meeting people before and afterwards in these breakout rooms,
Mm-hmm.
and just hearing stories, and then connecting with these people afterwards, and maybe putting them. I might connect a LP guy with a general partner that we work with, and just being a connector. You will learn a ton by doing that, but you also might meet the right partner who will
Right.
bring what you need to close the loan that you need.
Mm.
So let's say you were doing it yourself. You had a 10 unit and you wanted to really scale up. Well, whereas you might be able to jump into a 25 or 50 unit by yourself, you can go out and partner with someone who's closed 4 to 5 deals, and they bring not only the experience, but they might have deeper pockets, so you have the liquidity and net worth to get you into a 100 unit plus deal. And if you're not selfish, if you're not, if you're able to kind of give some control up,
Mm-hmm.
and let that be a learning experience for you, that 100 unit deal, then you're going to scale a lot quicker. That I'm not saying that's the path for everybody. I've met several people who say, nope, don't want any part of partnerships. I just want to do it myself.
Right.
I totally get it, totally understand. But if you're someone who wants to scale quicker, that's the best advice I could give.
No, that's excellent advice. As a matter of fact, because and we said this a couple times during this particular episode, is that teamwork in multifamily means a lot. This isn't a single player sport. It's not the same as tennis or boxing or single family flipping, which all equates to the same thing because all of them hurt, in my opinion. So it is definitely a team sport. It makes it easier to execute. It's less you have to worry about, and you can kind of focus on your strengths as opposed to others.
That's
So
right.
now, with me running my mouth on that, let's go to the next segment, which is situational awareness. And what situational awareness is, Clay, is you give the listener something they can read or they can take in just mentally and just pay attention to that'll make them more aware of the current situation with multifamily and where multifamily might be headed.
Oh, for multifamily. Okay, I was going to
Mm-hmm.
recommend a book, but it's not
No,
multifamily based.
if you want to recommend a book, Clay, recommend a book because it's still situational awareness. I like it.
Sure. Well, most people have heard of it and maybe read it, but The One Thing by Gary Keller and Jay
That's a
Papasan,
good one. Yeah, that's a
um,
good one.
really, really good. I cheated. I listened to it on Audible, but listened to it two to 2.5 times now. I think
Right.
in the last half year. Um, Really impactful. I think if you put these not just the ideas, but the way they coach you, put those types of things into practice, where you're looking at your long-term goal. What steps does it take? Let's say you have a 5-year goal, and you backtrack. You start with the end in mind, if you will. Backtrack to that. What do I need to accomplish in the next 12 months? What do I need to accomplish in the next quarter? What do I need to accomplish in the next month, week, and what do I need to do today to
Right.
to to make it easier to get that goal. So that's one thing I would definitely recommend. A book I'd recommend. As far as the industry is concerned, wow, I have found immense value with podcast,
Hmm.
um, and that's, I mean, by the time this is released, and I don't know when, if it's, even if it's released in a week, there'll be some kind of new thing that will have made that ancient technology probably. But podcasts, I
Right.
think, are great, a great medium. Clubhouse is coming on strong, and
Yeah, it is.
I love listening in on some of these discussions and participating in some of the discussions on Clubhouse. It's almost as if you're like a fly on the wall of some industry experts, and just soaking it in.
Right.
So yeah, I would say that. Also, boy, it's going to really sound like I'm pushing old capital on everybody, but
No,
we
no.
do
It's
we do
fine,
have
Clay.
a great
Push.
YouTube channel. I would point people to, if you want to learn some of the particulars about multifamily, like how lenders size deals, how to
Mm,
underwrite a deal. James Ing, in particular, has done an outstanding job putting together a lot of content. It's just very pragmatic, straight to the point. Doesn't take a lot of your time, and you'll learn a lot. There's a lot of information out there floating around. That's a good single spot for a lot of that information you need.
absolutely. I love it. I love it. Is there anything you'd like to plug while you're here, Clay? Outside of, well, I mean, just plug more Old Cold Capital. That's fine. Let's keep going a little bit.
Well, not me. I'll just plug me. Boy, I don't think so, and I might kick myself when I'm laying in bed tonight. I might think, oh, I should have said this or recommended that. But I would absolutely love to work with I've enjoyed working with you and your team, and then anybody that any GPs, aspiring GPs, early stage investors. Give me a call. I'll be more than happy to spend a few minutes on the phone with you. We'll
Awesome.
walk through a deal that maybe you're looking at, your underwriting, talk markets, and happy to help in any way possible.
Awesome. Awesome. Well, we truly and absolutely appreciate you coming on, Clay. This has been definitely eye opening for me as somebody who was really working to learn more about the lending side of the house as opposed to the marketing side, which I work on.
Mhm.
I really, really appreciate you coming. I cannot tell you how much and how honored I am that you came on today.
Oh, listen, the honor is all mine and the pleasure is all mine. Thank you much.
Fantastic. All right, guys. I'm Oliver Perry. You can see me at the Oliver Perry on IG. You can also find me at the Oliver Perry on LinkedIn and on YouTube at the Oliver Perry Show. Man, I got a long list. I got to find a better way to do this. So we appreciate you guys tuning in. We look forward to seeing you on the next episode. Have a great day.